Bitcoin is going just like the dot-com. Big bubble on high valuations on an early stage, which is way overvalued. Big crash, a lot of them go under, and then the real revolution comes, and you got the internet being the biggest boom in history into recently. So that's the same thing going on here. Blockchain can restructure monetary systems with a potential Bitcoin gold-like standard at some point when Bitcoin gets high enough and stable enough, where you could have a bottoms-up system that grows totally by transactions of consumers and businesses and governments, and is no longer top-down micromanaged by central banks and politicians who always overstimulate, always push down their currencies to cheat for exports. All governments do is manipulate in the wrong way. We got to get rid of this. Now that brings me real quick, 250-year, another giant cycle hitting here. This is very rare, Danielle. You see this many. The Protestant Revolution 500 years ago took down the Catholic Church down to where reality, okay? They controlled everything. And then the monarchs controlled everything. Well, democracy in the United States, late 1700s, 250 years ago, took down that and brought, democracy and free market capitalism from Adam Smith in Scotland and a whole industrial revolution. This now, I think this revolution's about bottoms up monetary system. Again, everything's about let the people make more decisions, let power go downward, decentralize. And this whole GameStop thing was just the first little taste that little guys can take down a hedge fund. Whoa.
Yeah, I wanted to talk to you about that. I'm happy you brought that up. I think Mark Cuban was even talking about this yesterday, saying like, this is not going to go away. It's not like some guys lost money, put their tail between their legs and they're never coming back. I mean, how will this change the landscape of Wall Street here? I mean, are hedge funds going back to the table not thinking, okay, we need to strategize. How do we stop this from happening again? How does this play out, Harry?
Okay, here's what happened. We have a lot of imbalances in the economy. Let me draw a quick picture for you.
Yeah.
Federal Reserve and central banks decide to print massive amounts of money to pull us out of a recession that looked like a depression, and it would have been a depression. They were right about that. So they wanted to pump our way out of it. They print all this money that only goes in, they're only buying bonds and financial assets in the markets. They're adding new money printed out of thin air to an existing base of financial assets. Number one, that's going to push up assets and always end up more in stocks in the end, okay? Number one. Number two, Wall Street, all the big hedge fund managers and leveraged traders, they say, oh my gosh, now that we know that the Fed's going to consistently push up stocks and down short and long-term interest rates, we can make leveraged bets. We can add a lot of leverage now to long-term trades. So they're adding leverage on top of the financial injections by the Fed. So now there's even more money chasing those stocks. And what it's led to, and I've been warning everyday traders and investors about this for many, many years, exactly what's been exposed here. The large traders see everything. They got better information than us, faster transactions, more access to leverage. They see when everybody's going in one direction, they will attack it with what I call predatory investing. It's not just simply, oh, we think this market's going too high, so we'll bet against it and short. No, they short with 10, 20 times leverage, and they push the markets down strongly, force all the bullish people to capitulate. And when they capitulate, they turn around and buy their stocks and then play the next run up. It's predatory. It's not good investing, and it's not fair to everyday investors. Well, these everyday investors now get on, Robinhood and Reddit, and they can talk, and they're like, now they're saying, well, you know what? They look at everything we do. There's one thing we can see that they're doing. We can see when they're over shorting a stock. And what they do is say, now we see them, they're leveraged to the hilt, expecting to push it down. What if we push it up with thousands of traders against them, force them to capitulate the other way? In other words, this GameStop, this Robinhood Reddit trade has done to the hedge funds what they do to everybody else. So to me, what's important here, Daniela, we're exposing an imbalance in the markets. There shouldn't be so much leverage. Options and futures were created so real businesses could hedge real commercial risk on having to buy or deliver commodities or financial assets in the future. It wasn't designed for predatory investing and to leverage up and just manipulate force markets down or force markets up. And again, now the little guys can do the same thing. So good win for the little guys. But what it does is exposes it. I think it's going to be a big issue, especially when this bubble crashes again, just like people will finally question, well, did central banks do us more good or harm? Answer, harm. It'll be, wait a minute, all this, whether the central banks are or manipulating markets with leverage or gangs of traders, mobs of traders, let's call them, it's not a good thing for investment. It creates a casino economy. And so I think there's going to be simple regulations. All you have to do is disallow high leverage, except for things that are really hedging operations and not for predatory investing. So I think this is part of the revolution of many things. And it's going to be a good change when it happens. But again, it's going to take the bubble bursting and people seeing the cost of excessive monetary creation, a cost of excessive leverage in investing, creating such a bubble that when it bursts, it overnight destroys $2 to $250 trillion. Again, you can't have that much money disappear without creating a depression. This will not be a recession. On the other hand, my good news is because I understand demographics and understand how fast you can deleverage these things, like 29 to 32, I think by 2023, we're going to be coming out of this with the millennial generation. So this is not going to last 10 or 12 years.
Okay.
The next 2 or 3 years is going to probably be the worst we see in our lifetime.
So basically what I'm hearing from you is no sector gets saved come April. But
except for the highest quality bond. The best safe haven, you can go to cash and preserve while everything goes down. That's good. What is great is to buy a 30-year, the longest duration, safe treasury bond. That will be the safe haven because their rates will go from 1.8 be pushed down to near zero. That'll cause that bond to appreciate 40% or more when everything else drops. Normal corporate bonds will drop some, junk bonds will drop more like stocks. There will be you're right, there will be very little places to hide. Cash flow assets, solid cash flow assets, and the highest quality bonds, and that would mean only AAA corporate bonds. I'd still rather have the 30-year treasury bond.
Okay, 30-year treasury bond. Harry Dent, why not gold?
Because gold is an inflation hedge. This is going to be like 2008 started to be before they turned on the fire hoses to combat it. And that's why we haven't had inflation. They're combating deflation, which always comes after bubbles, okay? So it's going to be a deflationary process, and gold edged up into the 2008 recession, the early stages. And when they saw Lehman Brothers goes up and saw the deflationary breakdown, gold went down 33% in like 2 months, and silver 50%. So gold will not go down as much as some commodities, but gold is not going to be the safe haven in a deflationary environment. And Bitcoin is not either. Bitcoin is not a safe haven, nor is it an inflation hedge. And the institutional money in Wall Street is buying Bitcoin as an inflation hedge instead of gold. It's not gold. It could be gold in 15 years. It's not gold. It's not an inflation hedge. It's not a safe haven. It is the biggest bubble, which means it will ultimately burst the biggest along with stocks.
And you're right. Gold did go down with the Lehman Brothers and that catastrophe. But what happened right after? It wasn't long that it was down.
It was only because they turned on the fire hoses, and gold loves money printing because they see inflation. Right. Now gold went up, Daniela, and then in 2012 it went right back down because even with all the money printing, inflation was still going down at some point, and gold finally realized, oh my gosh, and gold bugs have been wrong about this. You don't get money, you don't get inflation in a deflation era. All you do is curb deflation. You're not. I tell people in speeches, and I say this seriously, there is no way in hell you can create high inflation, nevertheless hyperinflation, in this winter season deflationary environment with so much debt and bubbles, always pushing to deleverage, which is always deflationary. 9 out of 10 financial crises in developed countries have been deflationary, not inflationary. So I have to argue with the damn gold bugs too. I was introduced at a gold conference as the contrarian's contrarian. They think they're contrary. I am contrary to them. We both see a crisis, but I see deflation. That changes the investments that do well.
I understand. So right now, you're in 30-year treasury bonds and cash.
Right.
That's your prime. That's where your portfolio is right now.
Well, yes, that's right. And also, I think and this is where risk tolerance come in. People can just simply unlevered short stocks. Just short the S&P 500. Short, you buy, I think it's PQQQ, and you can be just simple one-time short the NASDAQ. That is going to go down. You can do that 10, 20, 30% of your portfolio. I wouldn't do it 100% because downturns even more volatile. But shorting stocks, the one asset that goes down the most consistently and does go down the most, more than real estate, more than bonds, is stocks. So you can be, the ideal portfolio is maybe 10% cash, 50% 30-year treasuries, and 20, 40% or something like that, short stocks, but not leveraged. Just simple short.
And let me end on this. I could keep going on forever with you, but let me end on this. I want to pick your brain on this. How do you resist the temptation to not follow the fever, right? Bitcoin fever, or Ethereum today as we're speaking, or GameStop? What conversation do you have with yourself and say, hey, it looks so tempting. I could really make a lot of money here. How do you stop yourself? Or, what do you think in your head and say, look, don't do it?
Well, you have to understand bubbles. You can make money in bubbles if you're quick, okay? The people who got into GameStop to push it up first and got out first made a bunch of money. Most of those everyday traders that jumped on as like, oh, this is fun. Oh yeah, we are killing the bad guy. Well, then it went right back down to 112, okay? 42, it went up to 482 and down to 112 in the same day. So that, a lot of people got killed on that. You have to understand the nature of bubbles. If you're gonna be in them, look at the progression. I one of the things I do, and I hate to admit this in public, but I use the Masters and Johnson's male orgasm documentation from their study in the 1950s. It is a perfect exponential bubble curve ending in an orgasm. And what you have to understand about that is that bubbles, when they do burst, as fast as they go up, they go down twice as fast, and they always go back to the bubble origin where it started and wipe out the entire bubble.
What point of cycle would you say Bitcoin's at then? Because if you speak to Bitcoin pundits like Max Kaiser, and they're looking at 220,000 as a target in this year, they'd say you got to zoom out of the chart. You can't zoom in. You got to look at the chart from far away, and you'd see the volatility is not so bad. But you're obviously saying not the case.
Okay. Yeah. Those guys don't have long-term perspective, but they are right. I have two scenarios that Bitcoin's either just peaked or about to peak on a more linear progression, or I have an exponential chart now that they've broken some key levels on the upside, which is a positive thing for it. It could get as high as 160,000 near term, or 300,000 if it can last the end of this year. I still say it's going to crash 95%. So if you're getting in now, I think it's late. It could go up or down. But I'm saying by the end of this year, and I think more likely sooner, it's going to peak, and you're going to see a bigger crash than you've seen yet. And you're probably going to see Bitcoin back at 3,000 to 4,000. That is when I would load up the truck. That would have been like buying Amazon in the 2000, 2002 crash at the bottom at $6 down from 133. Okay.
At what price would you buy gold at? When would you load up on gold? If it fell below what level?
That's a great question. I've had this target for a long time. I think it's going down to 1,000, back down to the 2015 low or a little lower. That is going to be a lot less. That's only be a 50% crash from here at most. Most commodities are going to end up down 70, 80%. Then I would buy it, because gold is going to be another 30-year commodity cycle. And gold's going to be one of the leaders, because one of the outstanding things in the next 30-year commodity cycle is going to be driven less by inflation and more by Asian buying, and Asians love gold. Chinese and Indians per income buy even more gold than anybody. So gold will be a good buy, probably 2 years from now, near the bottom of the stock crash, and I'm guessing 950 to 1,000.